This is Nightly Business Report with Tyler Matheson and Sue Herrera.
How healthy? After 3 months of disappointing growth and mixed signals along the way, tomorrow's jobs report could bring the picture into focus. We'll look at the state of the labor market. What's in a name? How do you know that organic food on your table is really organic? The answer is more than just looking at a label. And class action, why one lawsuit accuses a drug company of illegally driving sales of its pain-killing drug. All that and more tonight on Nightly Business Report for Thursday, November 5th. Good evening, everyone. Ty is off tonight. After 3 months of disappointing job growth, tomorrow's government employment report will go a long way in determining whether that slump was temporary or a bit more. It's also the penultimate jobs report before the Federal Reserve's next meeting in December, where many believe the central bank might raise interest rates. Hampton Pearson takes a look at what to expect and where we stand.
Most leading economists and Fed watchers are looking for a rebound in job growth in October. The consensus forecast calls for an increase of 180,000 jobs added to non-farm payrolls, well above the average of just 139,000 for August and September, with headline unemployment holding steady at 5.1%.
We're expecting about 180. If it comes in anywhere north of 150, I think the market will still believe that they plan on tightening.
It's the first of two employment reports that will be on the desk of monetary policymakers when they meet in December. A meeting described this week by Fed Chair Janet Yellen as a live possibility for the first rate hike in nearly a decade.
What the committee has been expecting is that the economy will continue to grow at a pace that's sufficient to generate further improvements in the labor market and to return inflation to our 2% target over the medium term.
The economic data is mixed. Last week, jobless claims posted the biggest weekly increase since February. But the 4-week moving average shows claims at their lowest level since November of 2000. Meanwhile, the Labor Department says worker productivity actually increased in the third quarter, with manufacturing producing more new cars and other big-ticket durable goods leading the way. But year-over-year productivity remains weak, and a major contributor to stagnant wages, economists say, because businesses are reluctant to invest in new plants and hire more workers.
If you're getting more out of each worker employed for the same rate of growth of output, then you'll need fewer people and payroll growth will slow.
In recent months, a rebound in consumer spending has been the key to overall economic growth. A strong jobs report heading into the holiday season could make that Fed decision in mid-December a little more transparent. For Nightly Business Report, I'm Hampton Pearson in Washington.
Despite some disappointing jobs data this week, the staffing firm Challenger Gray and Christmas released positive labor news today. According to the report, overall layoffs fell 14% last month, but the number of job cuts in the oil patch jumped to a 6-month high as that industry struggles with persistently low energy prices. So John Sylvia joins us now to talk more about the state of the labor market and what this mixed data is really telling us about the jobs picture. He is chief economist at Wells Fargo Securities. Good to see you again, John. Welcome back.
Thank you.
Let's start, first of all, with how you interpret this data. It has been choppy. It's been a little bit confusing. Tell me how you see the labor market right now.
Well, I think Hampton's got it right. There will be a rebound, and 180,000, 190,000 sounds about right to us. But I certainly agree with your characterization of mixed, because what we're really seeing is the domestic service sector in the United States, especially, consumer spending, as was mentioned earlier, is really pretty solid. What is weak, of course, is the manufacturing and the export sector. So what we've seen is the service numbers are pretty good in terms of jobs, but manufacturing's taken a little bit of a hit. So it indeed is a mixed picture overall in the U.S. economy.
Kind of a tale of two economies, if you will. So what is the growth rate in general in jobs going to look like for the foreseeable future?
Well, I think it's going to moderate relative to the last 2 or 3 years. We've had really pretty solid years of job gains of 200,000, 220,000 on average. I think we're going to see now going forward 180, 190,000 probably is going to be the pace of job gains over the next 12 months. I think one of the challenges here, as I'm sure you're aware, is labor force participation rates have slowed down. Labor force growth has slowed down. And as a result, there's just less people coming in, and somehow companies have become accustomed to slower economic growth, so they demand fewer workers. So there is definitely a slowdown in place.
And I know that the Fed is probably looking at all of these very same things. Where do you think it puts them in terms of a possible interest rate hike in December? Because that has also been the big topic of discussion after Ms. Yellen's testimony the other day.
Yeah, there just still seems to be an expression at the Fed that their expected inflation rate will pick up towards 2%. And my sense is with the gains in employment, the unemployment rate staying around 5%, 5.1, that's probably going to be enough evidence for the Fed to move in December.
All right, John, we'll leave it there. Thank you so much. John Sylvia with Wells Fargo Securities. Dow component Disney posting a mixed quarterly earnings report. On an adjusted basis, the entertainment company earned $1.20 a share, beating estimates by 6 cents, helped out by its media networks, particularly ESPN. Revenue of $13.5 billion was a very slight miss, but essentially pretty much in line. Shares were volatile after the report and were off a fraction in the regular session, closing at $113 a share. Julia Boorstin tells us the one thing investors should focus on in Disney's numbers.
It was strength at ESPN and Disney's other cable networks that drove Disney's earnings higher than Wall Street predicted. That strength of ESPN perhaps surprising after Iger's comments last quarter, lowering expectations for ESPN and raising concerns about the health of the traditional TV business sparked a sell-off of media stocks.
We feel really bullish about our television businesses, in particular ESPN. And looking back on the quarter, if we could do it over, we wouldn't. We wanted to be candid about what we were seeing. The fact remains that the guidance that we updated back then remains in place today, and ESPN's future, particularly given the array of great programming that they have and the demand that I just mentioned that's out there in the marketplace for it, remains very bright.
Iger saying that as Disney sees more competition from platforms that offer more mobility, he sees more opportunity than ever to distribute Disney content direct to consumers and to reach a bigger audience. Back to you.
Thank you, Julia. Stocks barely budged as investors wait for tomorrow's employment report. The Dow Jones Industrial Average was off 4 points to close at 17,863. The Nasdaq fell 14 points, and the S&P 500 was down 2 points. Well, this holiday season is fast approaching, and the Postal Service is gearing up. It's expecting to deliver more than 15 billion pieces of holiday mail and packages this year between Thanksgiving and New Year's Eve. That's a 10% increase when compared with last year's volume. The Postal Service plans to hire 30,000 employees to meet that demand. It's also the busiest season of the year for the shipping industry, and its biggest carrier is issuing a profit warning. And that's not the only worrisome sign for an industry that's deeply entwined with the global economy. Morgan Brennan has more.
Call it a shipping slump. The world's biggest ocean carrier, Maersk, is slashing 4,000 jobs and halting deliveries of new vessels. This after a surprise profit warning. And Maersk isn't alone. Many operators are reporting disappointing earnings and downbeat outlooks. And German operator Hapag-Lloyd, which is going public, has had to cut the terms of its stock offering several times. Analysts say the industry is facing a number of headwinds.
Developed economy demand has been fairly slow, and so we've seen, overall a deceleration in the pace of demand growth. We have seen a lot of supply coming on as well, but really that's one of the major factors is the fact that we're just not growing as a global economy as fast as we have in the past.
Shipping Association BIMCO says 2015 is experiencing the, quote, highest inflow of new capacity ever, as mega ships capable of carrying tens of thousands of containers come online. Couple that with slowing global economic growth, particularly in China and Europe, and shipping rates have plunged to multi-year lows. Still, not every company in the business is struggling. Seaspan Corporation, which owns and leases ships in long-term contracts, believes this is a short-term rough patch.
We are very confident in long-term prospects of the industry. The industry has gotten much bigger and much more sophisticated. The operators, our customers, know how to navigate through the ups and downs. The demand has been weak for certain trades, but North American trade is very, very strong.
But whether North American trade can remain strong is the key. U.S. economic growth slowed to 1.5% in the third quarter, according to early estimates from the Commerce Department. And some container ship operators are warning that the late summer through fall peak season, when they ship all of those retail goods in containers, never really came. That could be an early indicator that the holidays might not be as strong as expected. For Nightly Business Report, I'm Morgan Brennan.
Coming up, a $40 billion industry that relies heavily on honesty and why that could have a big impact on what you eat. When you think of Seattle and business, names like Microsoft and Amazon are likely to come to mind. And as Kate Rogers tells us, those big names are helping to attract talent and make Seattle's startup scene one of the best around.
Microsoft hasn't been a startup in decades since Bill Gates and Paul Allen launched out of a garage in 1975. But the tech giant, which is based in Redmond, Washington, is getting back to its roots in nearby Seattle, gearing up for its latest cohort of Microsoft Ventures. This is Microsoft's Global Accelerator program, with 410 graduates that have raised $1.2 billion collectively in funding. This latest round of startups in Seattle will focus on machine learning.
You have great enterprise companies in this area, so it's a great place for us to do both work with startups on cloud, work with startups on enterprise software, and we're very interested in this class with data scientists and the whole machine learning space.
From anchor tenants like Microsoft and Amazon to a network of incubators and accelerators for new companies, Seattle's startup scene is thriving. It ranked number 8 on Compass's Global Startup Ecosystem report in 2015 for startup cities around the world. As far as accelerators go, Fledge is a bit different. If you want to become the next Etsy or Tom Shoes, this is the place to be.
Fledge helps what we call conscious companies, which are mission-driven for-profit companies. So these are companies that are trying to do good in the world, but doing it as a business.
Applicants come from all over the globe. In 3.5 years, they've had 39 grads collectively raise $10 million. The accelerator is funded by impact and angel investors. And past grads have found ways to recycle cotton and grow sustainable escargot domestically. And cash is flowing into Seattle quickly. In fact, the city says in the first half of 2015, there have been 99 deals so far with more than $900 million in investment. But there's one more area of growth in Seattle that can't be overlooked: recreational marijuana. After being legalized in 2012 and going on sale last year, entrepreneurs like Ian Eisenberg are cashing in. He's doing about $1.4 million in sales each month.
Well, Seattle's always been sort of the end of the line frontier city, and it still is. You know, we're leading the world right now in legalized pot, and it's also got a vibrant art scene and music scene. It's not just tech. And that's why a lot of the tech companies want to locate here.
Industry watcher Greenwave Advisors, LLC, projects Seattle's recreational market will hit $49 million in 2015, up from approximately $9 million in the second half of 2014. Tech startups to conscious companies and even marijuana shops, Emerald City's small businesses are seeing green. For Nightly Business Report in Seattle, Washington, I'm Kate Rogers.
Cost cuts help Ralph Lauren post results that top estimates, and that is where we begin tonight's Market Focus. Although the apparel maker posted results that were better than expected, its quarterlies were lower when compared to last year. This as the strong dollar resulted in a decrease in tourism in the company's most recent quarter. That weighed on store traffic. Nonetheless, shares soared nearly 15% to $130.45, making it the best performing stock in the S&P 500 today. Kraft Heinz reported declining results following its recent merger. The company also announced a dividend hike. Its payout will now be 57.5 cents a share and will be payable on November 20th. Shares were volatile in after-hours trading. During the regular session, the stock was off just a fraction to 75.42. The New York Attorney General has launched an investigation into ExxonMobil. The probe is looking into whether or not the company misled the public about the risks of climate change and how those risks may hurt its oil business. Shares of the Dow component fell more than 1% to 84.81. An executive announcement from United Continental, the CEO saying he plans to return to work in the first quarter of 2016. He's been out on medical leave following a heart attack. Shares rose slightly in initial after-hours trading. During the regular session, the stock was little changed to close at $60.30. Valeant Pharmaceuticals fell sharply again today in the wake of a Senate committee launching an investigation into drug price increases. Some on Wall Street are also reportedly growing concerned that a Wall Street Journal article may show one of the company's big shareholders might be wavering in his support of Valeant's management. The stock plunged more than 14% to $78.77. Time Inc. issued a disappointing guidance. This as the publisher continues to see a decline in print advertising revenue, but that's partially being offset by an increase in digital ads. Shares fell more than 5% to $18.01. And Shake Shack delivered strong results and reported a big increase in same-restaurant sales. On that, the burger chain hiked its revenue forecast. Shares popped initially after the close. During the regular session, the stock was up 4.5% to $51.11. Shares of Whole Foods were down more than 2% after missing on its earnings last night. The company's profit fell by more than half, thanks in part to the intense competition because organic foods are now more widely available. So, as Americans dish out more money for natural foods, are they really getting what they're paying for? Jane Wells has the dirt on what it really means to be organic and if you should trust it.
At last month's meeting in Vermont of the National Organic Standards Board, a government group which sets rules for the organic industry, local farmers protested outside that not everyone's certified organic grows in soil. And inside the meeting,
not one egg-laying operation had any chickens outside.
Another group accused the USDA organic program of being in bed with big agribusiness. It's a sign that some want to panic about organic, an industry which has grown to nearly $40 billion in sales last year in the U.S., closing in on nearly 5% of all food sold.
But now there's so much competition, and with kind of the recent challenges, growing challenges, especially with the recent drought, we've seen costs rise and prices kind of come down.
Garrett Nishimori's family has been growing organic greens for 12 years in California. There are 24,000 certified organic producers in the U.S. and more outside the country sending food here. But food bearing that USDA certified organic label isn't actually checked by the USDA, but by third-party contractors.
Is the webbing from the mealybug.
And certifiers are paid by the farmer.
Look at all this fungal growth.
To become certified organic, a farm cannot have anything conventionally grown on it for 3 years. Producers have to submit a plan and provide proof they're not using banned pesticides or herbicides. There's a lot of paperwork and an annual audit, like the one Tim Chang of certifying agency CCOF was doing with Debbie Ziegelbaum of Robert Sinsky Vineyards in Napa.
And this is a re-veg planting in the creek.
Chang looked everything over, but he did not take soil samples or test for pesticide residue. His company says that's done 5% of the time, and there are also surprise inspections. But former certifier Misha Popov, who worked for a different agency, said he never did any of that.
Sadly, we can't trust the organic label right now. It's a bureaucratic, honor-based system. And that's unfortunate for all the honest organic farmers out there.
I think it's really a mistake to make the assumption that the system is full of cheaters. There's no evidence for that.
It's an honor system, right? I mean, there are things that can be done, like they do testing to make sure there aren't residues and things. But when it really comes down to it, it's an honor system.
The bigger the industry grows, the greater the challenge to police it, especially foreign foods certified as organic by foreign inspectors. At the same time, plant pathologist Steve Savage says conventionally grown food in the U.S. has never been safer.
There's probably no place in the history of humanity that has had such an amazing, diverse, consistent supply of food. And yet, maybe nobody in history who is worried about it more.
For Nightly Business Report, Jane Wells, Los Angeles.
Coming up, why one drug company is being sued by investors over its sales practices. Here's what to watch for tomorrow. The October employment report is out, and also on the data front, a report on consumer credit. We'll hear from more Fed officials and be listening for any clues on an interest rate hike. And that's what to watch for on Friday. For the past few days, we've been bringing you reports on a company called Insys Therapeutics that markets and sells an extremely potent painkiller called Subsys fentanyl specifically. This morning we learned that the company's CEO, Michael Babich, has stepped down. The company also reported earnings today that included record sales of Subsys. Dina Gosowski brings us the final installment of our series, Pushing Pain, Profits Before Patients.
The goal was profits, regardless of the effect on patients.
Oregon Assistant Attorney General David Hart is talking about Insys Therapeutics, a publicly traded company that markets and sells a highly addictive opiate that the FDA says should only be used for persistent cancer pain, called Subsys fentanyl.
One of our biggest commitments is to remain profitable and cash flow positive and continue to build shareholder value by driving sales of Subsys.
Ongoing investigations and litigation, including a class action lawsuit against the company, accuse Insys of engaging in illegal activity to drive those sales. For example, the company has a prior authorization department, which offers to work on behalf of patients to get insurance to pay for the expensive drug.
The prior authorization unit would seek authorization for use which the label says is harmful to the patient.
According to this settlement, in Oregon alone, out of the pre-authorization forms submitted by Insys, most were for off-label use. The class action lawsuit also accuses some Insys employees of pretending to work for a doctor's office and falsely stating that patients had tried other painkillers that were ineffective. Investors suing Insys say the company offered the pre-authorization service to ensure dependence and addiction to Subsys, a very lucrative proposition for Insys. Shannon Walsh resigned from Insys in October.
I really wanted to come in here and, help cancer patients that are having severe pain.
Her father experienced that kind of pain during his battle with cancer. But when Shannon told management that she wanted to approach palliative care offices,
I was basically told, just don't bother to call on those offices because the patients would die too quickly. So they wouldn't titrate up to a higher dose and they wouldn't get a lot of refills. And so they weren't profitable enough patients to bother with.
And in a country where addiction to painkillers is a growing problem, putting profits before patients only fuels the epidemic.
Insys sent us this statement earlier today, quote, Insys takes patient safety very seriously, and we are committed to working with healthcare providers to help ensure the proper prescribing of our products. Our compliance program is designed with this in mind. We are cooperating with the governmental inquiries we have disclosed in our public findings. Dina joins me now on set. So, Dina, what is the latest on the lawsuit?
So the plaintiffs and the company have reached a tentative settlement which would require Insys to pay over $6 million to some of those investors who had purchased the stock.
All right. Now, a number of doctors are pushing back on the use of opiates. But this is a very interesting situation because that drug can help with pain. There's a fine line there somewhere, which I think your series really pointed out. There's a fine line about the use and then the improper use of this particular drug.
Absolutely. Just because a drug is indicated for a specific use by the FDA doesn't mean that it can't be used for other reasons if the doctor sees fit. So it's not illegal for the doctor to prescribe off-label. What is illegal is for the company to market off-label. So this class action lawsuit really questions a number of things. It questions why so much of that approval is for off-label use and why the insurers are approving it in the first place. So there are so many questions that are still unanswered in that process. What happens in that prior authorization unit for those kinds of results?
And, you know, it also begs the question, the liability for the insurance companies, if they are approving on a very large scale use of a drug for off-label use.
Absolutely. I mean, that's another great point. Do they know the patient's history? That's something that the doctor has to know. And in that prior authorization, the patient actually signs away his or her medical privacy and rights to the company in order for the company to try to approve the drug. Now, we spoke with one physician who said for a doctor who has staff, who's light on staff and light on resources, this is a great service. But what he emphasized is what they cannot do is go from fact to fiction. And that is another unanswered question here. But again, the company did not comment specifically on those questions that we did ask them what goes on in the prior authorization unit, but they did send us that statement.
And we should point out very quickly that you called the company during your shooting of this whole series numerous times. Yes. And it was only today that they got back to you.
Absolutely.
All right, Dina, thank you very much. Appreciate it. All right, that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching, and we'll see you tomorrow.